Now, listen up to all you traders out there who are concerned that rising unemployment could hurt oil demand. Goldman Sachs says that talk of that U.S. job losses are cutting personal spending is exaggerated, and it expects oil to rise by about 20% by year's end. Let's bring up this chart for you. It tracks the relationship in personal spending and crude oil futures. And if you look near the right side of the screen, you can see that spending has gradually rebounded, helping spur on oil demand. And Goldman says that personal consumption expenditure plays a more important role in oil demand than actual unemployment does. So let's get more on the status of oil and oil prices and other hot commodities at this point and bring in Jeff Clear, head of commodities for Asia at ANZ Bank, and he joins us from Singapore. Welcome back to the program, Jeff. Now oil and copper among your top picks so far, but you're expecting some sort of pullback, at least 10 to 15%. When are we going to see that?
Yeah, look, I think the question about OPEC that you had in your lead story is an interesting one, but you've got to recall that OPEC is still only complying at about 70% of their promised cuts. So instead of producing at around 24.5 million barrels, which is their quota, they're actually producing closer to 25.5 million barrels. And the consequence of that, of course, is we're seeing slightly more supply than demand in the market still recurring. You mentioned the US a little while ago. Yes, we are seeing the stock overhang there being cleaned up slowly but surely, but there are still very, very large stock numbers when compared to the 5-year average on any count, whether it's crude, gasoline, but more particularly so on distillates. So we still expect there to be anything up to about a 10% pullback from current levels. So there will be good opportunities to buy, but our term view is that oil and all energy markets are still destined to go higher.
Okay, well, what about that supply overhang, Jeff? Because earlier I was speaking to another energy analyst who said that really the price of oil is not reflecting the big amount of supply out there.
Yeah, I guess that's probably an argument that could be made, but when we recall that oil prices fell to near $35 a barrel earlier in the year, that was a definite overshoot to the downside as well. The market is more balanced now, even when we look at supply and demand right now, at about 84.5 million barrels on both counts. It's pretty balanced, and with OPEC targeting around $75 a barrel, we're not far away from that. We don't expect a big plunge down, and certainly we don't expect a huge ramp up in prices either. ANZ is still forecasting oil to finish on a crude basis at around $80 a barrel by year end.
And what about Goldman Sachs? As you heard that report that I just read there saying that personal expenditure really not showing that demand is falling all that much because of unemployment.
Yeah, having a big bearing still. I wouldn't be thinking that it's going to come from the personal side so quickly. I would be looking at more things like how countries like China, for instance, are still building their statutory petroleum reserves. They're probably about halfway to where they want that reserve to be, at about 500 million barrels, and I think in the longer term they'll take that even higher. So there's still a lot of stocking to be done at a sovereign level. And we've also got a couple of large refineries, particularly there also, that are coming online in the fourth quarter of this year that are going to also require to fill their tanks as well with substantial amounts of crude.
Okay, so Jeff, so $80 a barrel by year's end. What about next year, 2010? What's the outlook in terms of peak prices?
Yeah, we're expecting the trend to continue upwardly. We're bullish and devout bulls when it comes to energy across this sector particularly. When I say this region particularly, we would expect that oil prices will at some point next year test $100 a barrel again, and if not, slightly higher than that. So still, it's an upward bias that we have. We don't see a lot of downside from here, and that's the way we see it at the moment.
And of course, the weak dollar will continue to play into prices as well for next year?
Yeah, I think so. I think that's the case, and probably more particularly it has a lot more to do with the equity market as to the dollar on its own, and both are affecting the price of oil. I think that equities and a lot of the other commodity markets more generally have probably come too far too fast, and we could expect to see the enthusiasm for those asset classes temper a little bit in line with what we said a little earlier on oil. But yeah, they're having a bearing, no question about it. As long as the equity markets are continuing to go higher, then you can probably have a pretty safe bet that commodities more generally, but oil particularly, will continue higher as well.
What about copper? Speaking of hot commodities, we got to talk about copper prices. We probably don't have much time in this segment, but we'll come back to follow up on it afterwards. But quickly, Jeff, can you touch on copper prices for me? They've soared so far this year. Again, Chinese demand being brought in, but how much higher do you see copper going?
Well, in actual fact, we're looking for a pullback in copper of about 10% before higher as well. And the vast reason for that is that we expect that Chinese import numbers shown on Friday this week will follow what we saw in July. That is, we'll see imports actually reducing for most of the base metals, copper included. But it's really an infrastructure story. It's about electrifying all the power grids across the Asian region, and that will continue for some years to come. So we're bullish copper for that reason more than anything else.
Okay, Jeff, we're going to go to commercial break, but when we come back, we're going to talk more on copper. We're going to touch on other commodities as well. We have Jeff Clear of ANZ Bank on with us. So if you have any questions or comments you want to put to Jeff, you can send them along in your emails. AsiaEdge@Bloomberg.net is the address. We'll see you after this. Now let's get back to talking about commodities and bring back in our guest this morning. Jeff Clear of ANZ Bank rejoins us from Singapore. And Jeff, before we went to commercial break, we were talking about copper, and you said you still see a 10 to 15% correction in copper prices before you see it heading higher. I don't know if we actually got to any levels from you, but in terms of copper, what are you looking for 2010?
Well, I think, first of all, the correction will probably see us down to about the high 5,000s, $5,800 to $5,500 per tonne US. And then back upward again. We expect that we're probably going to see a 20% growth story from there, but nothing outstanding, not like we saw in the early part of 2008 and the latter part of 2007, but a simple incline based on the fact that infrastructure is a key growth area for the Asian region.
Yeah, what about Chinese demand? I mean, what is going to push copper higher at this point? Is it just China, or is there other factors involved?
Well, if you look right across the region, if you were to kind of draw like a crescent shape right across the Asian region, you'll quickly understand that power is a very, very key infrastructure program for most of the countries across the region. Countries like Indonesia and so forth have their population still only being powered at about a level of 52%, meaning that there is a whole big significant part of their population that still requires source from power at some point or other. And certainly the governments of each of the countries we're talking about across the developing world are trying to do their best to actually create that infrastructure, and China being the big one.
Okay, Jeff, let's continue this discussion on base metals, and we have to talk about gold, because obviously gold made a lot of headlines by cracking through that $1,000 per ounce mark. Where do you see it heading? Is that also due for a correction, since it seems pretty encompassing?
I think it absolutely is due for correction. We've now got in place, at least technically, a double top at around about $1,010 an ounce. And we have the previous high that was recorded in the fourth quarter of last year post the Lehman collapse at around $1,030 an ounce. If we don't climb through those two levels fairly soon, I think that a correction is certainly on the cards. One of the things that has come to light in the last couple of days is the announcement that BRK undertook a huge equity raising, and part of that equity is to be used for the purpose of actually collapsing down their hedge book. Now, as the producer hedge books continue to get smaller and smaller and smaller, that demand, that intrinsic demand created by those hedge books being crystallised and the losses being taken away and closed down, means that all that significant side of demand will disappear.
Okay, but longer term then, sure, we may see a correction in gold, but would you still advise investors to get in on these dips?
Yeah, I do. I think at some point or other we're going to find that inflation is a very concerted story right around the globe, and it'll be done so in such a coordinated fashion that we will probably see all inflation hedges come back to the fore, and gold will be the biggest talking point around that. We're also seeing and expecting more announcements from some of the central banks in the developing world around the place that they will have added to their gold reserves as part of their foreign currency reserve mix as well over time, and I expect that will be some of the buying we will see as well.
All right, and what about platinum? Because yesterday we had a story about maybe platinum is a better bet at this point. It hasn't run up as much as gold. What do you think of that sort of a play?
Platinum's got a similar outlook to gold in some ways. When you have a technical review of where platinum's been, there is a double top on the spot charts at around $1,295 an ounce. Until we break that level, I wouldn't be adding to my longs, that's for sure. If I was an investor looking at that market, I wouldn't be prepared to do that until I saw confirmation of a new range being formed. Now, one of the things about platinum, of course, is it's a key auto catalyst. And whilst we've seen auto sales increase over the past 5 months or so, there are reasons to think that that's probably coming to a close for now.
And is that the same reasoning for aluminum as well? Because we had a story recently that said this Cash for Clunkers program, it increased car demand, which may also have boosted platinum as a result as well. But what about aluminum prices going forward if we're seeing, I guess, car demand on the way down?
Yeah, I'm not bullish on aluminium at all, I have to tell you. And it is for the same reasons. Moreover, we've seen some of those Cash for Clunkers programs that you've just referred to coming to an end. And as a result of that, we will probably see aluminium, which has fared quite well as a price, doing pretty well out of those programs, falling back to about $1,500 to $1,600 per metric tonne. That's about $200 or $300 below where we are today. The simple reality is that whilst those programs are winding up, the demand that's come through for cars, new cars particularly, is going to disappear rather overnight.
Mm-hmm. All right, but Jeff, you're calling for this correction for the hard stuff, for also the base metals, commodities, also oil, and you're also calling this correction for sugar prices as well. What's the thinking here? What's going to happen to sugar?
Sugar's a very interesting story. Now, it all relates to India, and you may have covered this already, but obviously with poor monsoonal rains over there, we've seen a large forecast drop for the sugar production out of India this year. Some 12 million tonnes or thereabouts is the hole that they've got to fill by way of imports for other countries. Now, a lot of that activity has been taking place over the last month or so. We've seen significant amounts of sugar being bought from offshore and imported into India. There has been some announcements by the authorities there that they're trying to now cap that movement of those imports. But the reality is that the country still has a significant shortfall with which to fill, and we would expect that any dips in sugar for the short term at least will still be a significantly good reason to buy.
Sugar's still sweet. Okay, Jeff, nice talking to you this morning. Jeff Clear of ANZ, thank you for